Welcome to NM Serena. In this video, we are going to discuss regarding the speculators in a stock exchange. The speculators are those individuals who take purchase or sales decisions in the anticipation of some favorable price movements in the future. So they take the purchase or selling decisions now, expecting that the price may rise or fall in the future. Such persons are called speculators. And so they are taking decisions now based on what is going to happen in the future. For that, they have to make use of certain strategies. Only then they can reap huge profits. Otherwise, they will have to suffer the loss. So we can say that they are taking excessive risk because they anticipate future price movements and they attempt to outperform the traditional long-term investors. Normally, the public invests to make profit out of their long-term investment. They want to earn regular income from the security, or they want to get the income only when they sell it in the future. But speculators, they want to earn income in a short-term period. And so by using these strategies, they are trying to outperform the traditional long-term investors. They are experts in securities trading, due to which they are able to make profits in the short term. They need not keep their securities for a long period like the other investors or the traditional investors. They keep the securities only for a few period, or you can say for a short term period, and they purchase or sell accordingly when they expect some price movements in the future. And now let us discuss about certain such speculators. One of the important type of speculators is the bull. The bull speculators, they expect a rise in price of securities in the future. So they purchase the securities now so that they can sell it at a high price in the future. They buy now for selling in the future at a very high price. Thus, they get the profit out of the difference in the price now and then. So, they are called as bull. And in India, they are also called as Tejiwala. They are called bulls because bulls normally throw its victim up in the air. And these bull speculators, they expect a rise in price. And the bulls throw its victim up. That is why such speculators are called bulls. And what happens if the price does not rise as they have expected? If a person is buying a security for 100 rupees per share and is expecting that the price of that share is going to be 150 rupees after a fixed period of time or after a few months, but it is not rising up as he has expected. The 100 rupees share next month, it is falling to 75 rupees. Thus he incurs loss. So when acting on the basis of some anticipations, there is always a risk. And these speculators, they are always taking the risk. But they are experts in securities trading. Most of the time, they will be able to gain. Now the next type of speculator is a bear. The features of bears are just the opposite of that of the bulls. So the buyers anticipates fall in the price of securities and he sells securities and buy it in the future at low price. He may even sell securities that he does not hold. This is possible because of the provision for forwarded settlement. That is, If I buy or sell a security today, there may be 2 or 3 days time for settling the transaction. That is how they make profit out of these sales and purchases. So, taking an example, the bear is selling the security of AB Limited. He is selling the share of AB Limited at rupees 100 per share today, but he is not holding it, or he does not possess that shares. What he expects is tomorrow the price of that share is going to fall. So I can buy that share tomorrow at rupees 75 or at a lower price, and then day after tomorrow I can sell that securities to that buyer with whom I have made the agreement today. So I am selling the share today, and for settling the transaction, I am going to buy that share only tomorrow so that I can settle the transaction day after tomorrow. That is how the buyer sells securities without possessing it. And in India, they are also called as Mandiwala. The name bears has come to these speculators because they expect a fall in the price. And the bears, they walk with bowed head. They always look down and they push their victim down. That is why the bears are treated just like the actual bears. The bear speculators, they expect fall in price, and the animal bears, they push their victim down. So the term bears are given to these type of speculators. And if the price does not fall as expected, he incurs loss. That is, this person is selling that security for 100 rupees today, and tomorrow he is expecting to buy that security for 75 rupees. But tomorrow, against his expectation, the price of the security rises to 150 rupees. Then he will have to purchase it for 150 rupees for settling this selling, or for settling this transaction the next day. And he cannot cancel the transaction because he has already committed to sell that securities today itself. So the bear, they may sell the securities which they do not hold. He may also sell the securities which they hold. And the next type of speculators are called stags. Stags are bullish in nature. They expect a rise in the price of securities. They normally go for the securities of a new company. They purchase the securities of a new company for selling at premium after the allotment. But the price may decline after the allotment. In that case, the stag will have to incur the loss. The name stag has come from the animal stag because the stag feeds upon fresh leaves, and these stag speculators, they apply for fresh shares of a new company. That is why the name stag has been given to this type of speculators. And the next type of speculator is a lame duck. The lame duck is actually a bear. We have already discussed the features of a bear speculator. The condition of a bear who is not able to meet his commitments, that is called a lame duck. The bears are not able to meet commitments if the price of the security does not fall as they have expected. So, in that condition, they are called lame duck. The bear normally sell securities that they do not hold, and they are not able to deliver the security on the fixed date, and they have to struggle like a lame duck. That is why they are called lame duck. So, these are the important types of speculators in a stock exchange. Thank you for watching this video. For more videos, subscribe the channel.